We start with the Federal Reserve decision this week addressing persistent inflation, rising borrowing costs, and a whole lot of uncertainty. Jason Furman is professor of economics at Harvard and served as the chair of President Obama's Council of Economic Advisors. So, Jason, we got three things out of the Federal Reserve this week. We got a decision not to do anything about rates. We got a statement that didn't change a whole lot from what it had before. And then we got a news conference from Chair Warsh. Of the three, which was the most important?
The dissents were the most important. It's very clear where a lot of members of this committee want rates to go going forward.
And in the news conference, certainly Chair Warsh was asked about those dissents, why they dissented, why he disagreed with them. I'm not sure we got a clear answer to that question. Do we have a sense from him, from the way he thinks about it, why he did not join with the dissents?
I don't think we got a clear sense from him. I think Chair Warsh has 2 points, which I agree with him on. One is you want to look at financial conditions, and there's been a lot of tightening on the long end of the curve. Now, you need to be a little bit careful. Some of that is in anticipation of what the Fed is going to do. And if the Fed ends up not doing that, some of that would end up unwinding. But so far, financial conditions, at least on the rate side, have tightened. And second, this really is a different type of inflation than what we had a couple of years ago. It's not the same type of labor market tightness, high wage growth, high price growth, high inflation expectations that we saw in the past.
Before we get into exactly what you think is causing the inflation, let's talk about the level of inflation itself. We're often taught that core PCE is what the Fed really pays a lot of attention to. That has been rising fairly steadily. So it does give rise to the question, which was asked, what are you waiting for?
Yeah, I think that's a totally reasonable question. Inflation is, intolerably high. It's been intolerably high for 5 straight years now. The argument on the other side, in terms of what you would be waiting for, the two best arguments are, one, that rates may be set above neutral already. So there may be a little bit of a foot on the brake pedal. And yes, you could debate whether you should be pushing harder on the brake pedal, but maybe, and I think arguably and plausibly, you are on the brake pedal already. And then the second argument is the transitory one. And I don't think we're going to hear that word from any government official ever again, probably for another 50 years before they get over what happened last time they used that word. But implicitly, that is what the Dove case is, at least at the moment.
When it comes to the T word, whether we use the word transitory or not, how long is transitory? I mean, it's been 5 years now that we've been over 2%, and there may be different reasons for the over 2%. But as I say, it doesn't look to be going back to 2% anytime soon.
Yeah, the different reasons is important. I mean, it looked at the end of 2024 as if we were headed back to 2%. It was almost within spitting distance, and then it took off again. Why did it take off again? I think in part that was tariffs, which probably have added 0.5 point to a percentage point to the inflation rate. And then subsequently the Iran conflict, which has added maybe a few tenths more to core PCE, a lot more to headline inflation. And so in some sense, things were lined up nicely. Now, the story in the 1970s was one excuse after another. Each time you had high inflation, it might have been different than the year before. So you want to be a little bit careful if you find yourself making excuse after excuse after excuse. But, tariffs in Iran, they really are pretty big things. And they raise the price level. They don't permanently raise the inflation rate, or at least they shouldn't, as long as the Fed is credible.
And it raises the question, I think, whether the cause of inflation can be limited to the specific cause, whether it's tariffs or whether it's Iran and energy. When you start there, can it spread into other sectors of the economy?
Yeah, that's the most important question, and that's what the Fed is trying to figure out right now. And there's a few mechanisms for that. Some of it is direct, just the cost of jet fuel goes up, so airplane tickets go up. That's not the biggest concern. The big concern is if it gets built into expectations, and the way that manifests itself is economy-wide wage setting and economy-wide price setting. So if you see prices go up faster, and that leads to wages going up faster. And wages going up faster leads to prices going up faster, and you end up with a sort of persistent cycle. That is so far where I am cautiously optimistic. We're not seeing the wage growth commensurate with this type of inflationary economy, again, in the way that we saw it a couple of years ago. But that is where we would see the broadening out, if it really starts to show up, not just in specific prices, but across the board prices, and especially in wages.
Do the numbers coming out of the labor market cut both ways? There was a time not too long ago, there was a lot of concern on the Fed that, in fact, there was a loosening of the labor market. We needed to really keep rates low for that reason. That does not appear to be true now. It's more stable now than it was 6-9 months ago. Does that give the Fed actually some license to increase to address the inflation question?
Yeah, it absolutely does. The Fed has two mandates. The employment mandate right now is in better shape than I can almost ever remember. Normally, the unemployment rate is either too high and it's coming down, or maybe it's too low and it's rising quickly, or something like that. It's just been amazingly stable. It peaked in November of last year. It's fallen a bit since then. It's basically the same place for the last 2.5 years. And it's not clear what would dislodge that unless there was some big exogenous shock to the economy, say the AI bubble burst. And I don't think there's any reason to expect that to happen anytime soon. So yeah, the Fed really just needs to worry about the one side of its mandate right now, which is inflation.
The Fed certainly does not say it moves off of the markets, but the markets are a data point. And one thing that happened in the wake of the news conference was particularly the yield on the 30-year going up to the highest level in 19 years, since before the great financial crisis. Is that some information that Kevin Warsh and the members of the Fed need to take into account? What does that tell them?
What that tells them is that markets to some degree are expecting them to keep their word. A lot of that movement was in the real rate, not in expected inflation. It says they expect the Fed to deliver rate hikes as needed to keep inflation under control. In some ways, I saw that as a sign of credibility that the Fed would be there to deal with this problem. That being said, I'm not entirely sure of the strategy that you try to keep the markets calm by not speaking, and then you deliver some big surprises. In some sense, the meeting itself was a surprise. We didn't know. I expected them to hold, but it was much less certain than it often has been in the past. The dissents were a surprise. Some of the communication was a surprise. And so some of this volatility, to me, seems unnecessary, and I hope it's a growing pain, not something that's here to stay.
Well, we'll talk about that communication issue, because Chair Warsh from the beginning has made no secret of the fact he does not believe in a lot of forward guidance. He thought it might have been necessary when we were coming out of the great financial crisis. Don't need it anymore. And so he's moved away from that. But at what point does that really undermine some of the stability in the market? Because as you say, then you wait and you get a big surprise. Is this really giving rise to some doubt about his new policy of really cutting back on forward guidance?
Yeah, forward guidance was overdone, but we don't want to go too far in the other direction. First of all, a lot of members of the committee are going to be communicating. So if you don't hear more authoritative communications, you'll end up with more noise and confusion. Every time the chair does communicate, you can end up with a bigger reaction. And then finally, I think most important, what the Fed really needs to grapple with, which is if it wants to talk less, it probably needs to act more. Chair Warsh was relying on the moves in the long end to justify not moving rates. Well, part of why the long end is moving is an expectation about what the Fed is going to do in the future. Where does that expectation come from if the Fed doesn't communicate? In a world where the Fed wants to say less, maybe it's going to actually need to move rates more aggressively. And so it lets its actions speak rather than its words. And I haven't seen any willingness to do that.
And it's all about that critical word you raised, which is credibility of the Fed, which is we all need. The markets need it. The economy needs credibility of the Fed. And some people today are questioning whether they've lost a bit of credibility. What is the danger here, particularly as I, as not an economist, look at this over 5 years, over 2%, and you say, oh no, we're going to get to it, we're going to get to it. You know, if your child said that to you over 5 years and never did it, you'd have some doubts.
The Fed is starting with an enormous amount of credibility. Now, it doesn't want to be reckless and spend that credibility willy-nilly. That would be a real mistake. But, you know, to me, it's amazing. 5 years of promising inflation will come down, having inflation not come down, and yet having the market expectation of inflation still be really tame is a testament to the way in which people believe in the Fed. So far, Chair Warsh has said all of the right things. He may need to actually start putting his money where his mouth is if he doesn't want to start, you know, going into deficit on the credibility bank that the Fed has built up over the years.